Hey everybody, this is Brant from Wolf on Wall Street Trade with a market update for the week ending May 3rd, 2019. I haven't done many videos over the last month because it has just been a really dull month, like watching paint dry. But I think as we go into May, we're going to see some more volatility, and we already started to see that this week. So I'm going to do a quick recap of where we've been, where we are. It's kind of like on a map. You know, where have you been, where are you now, to get to where you're going. So let's pick it up from the March FOMC meeting, which was right here. And this little green bar, or big green bar actually, was the response to that March FOMC meeting. And I always warn subscribers, members, beware of these FOMC meeting knee jerks. So a big day up here, or a big hour up right after that FOMC, and the day closed, you know, with this red bar. It was really ugly close, and then we got this big ramp, and this was the S&P up about 1.10%, and then the next day, and by the way, I thought this was kind of a like a stick save because the day had closed really ugly after that FOMC meeting. In any case, up 1.10%, and the next day down almost 2%. And this is where we had all the yield curve inversions, like the 3-month and the 10-year yield inverted, which is typically a recessionary sign 12, 18 months out. So we came down the next Monday over here, and we have this little test. So this is Monday morning right here, and this is Monday afternoon right here. And then later in the week, I think this was Wednesday, that was tested again. So for members of the site, the thing I was queuing on was that small caps were outperforming here. So this is small caps in blue, IWM, and the S&P here in the red and green candlesticks. And this is normalized as of about March 14th. So it looks like, you know, small caps are doing worse, which they were. But what I want to focus on is the test here. So there's Monday morning, a test later Monday afternoon. Notice that small caps make a higher low right here, and then later in the week, I think this is Wednesday, that level was tested again. So it became kind of evident here that the market was going to kind of come out of this and be okay at that point. And we move into April, and the two main moves were right here. This was, I think, Monday, right? Yeah. So this was Chinese data that came out over the weekend. So Monday gapped up real strong. The week kind of just went sideways here. Did make the higher low over here, so it kept this trend. This is kind of where I started the trend line from and just extended it. And then this gap up again was Chinese data that came out overnight, and that caused the market to gap up again. So that next week was just torturously, painfully dull and boring. So this is that week, and basically the S&P 500 was vacillating around 2,900. It looks like about 290 here on SPY, but 2,900, and that became a really apparent, important level for the S&P. Now, something I'm going to cover later in this video, and it's kind of the real main point of the video, was what was happening in this area. So here's the April trend, and this is kind of a constructive little triangle for the S&P. And now, if we look at this past week, this is the FOMC meeting. So really bad reaction, not to the policy statement itself, but to what Jerome Powell said afterward. There was this narrative or notion going on that there might be a Federal Reserve, what they would call an insurance rate cut, like they're cutting rates now to stave off future economic weakness. He just slammed the door on that at that point, and that's really what caused the market to sell off here. And it sold off again Thursday and broke this trend line for this April trend. Now this happened in a lot of other sectors too, and my opinion was that we were probably going to back test this trend line here. And then we had the GDP report this morning, which looked like Goldilocks because you had job gains, but you had limited wage inflation. The one thing I do want to point out real quick, and I always tell my members this, beware of knee-jerk reactions around the Federal Reserve. So we saw a knee-jerk reaction here, up, down, the next day up, the next day down. This looks very similar to what is going on in this past meeting this week. So I'm just saying beware of the knee-jerk reactions. It takes the market a little time to sort through that and figure out what it really thinks of what was said. Another thing that kept the market really calm is that bonds, treasuries, pulled back this entire time. So if I pull up the, let's use, I got the 10-year yield here. So I pull up the 10-year yield. That's in blue. Now remember, yields move opposite of prices in treasuries. So the yield moving up means the treasury is moving down. Now this is that week or that day I was talking about after the Federal Reserve where we had yield curves invert. You can see yields just plunged. I mean, it was just absolutely spectacular, horrifying. And then into all of April, here's April 1, you can see yields are pretty much tracking with the S&P, and we were expecting bonds to pull back. The pullback lasted a little bit longer than I thought, but one thing I kept saying was after treasuries finish their pullback, expect the market to get more volatile. So this is where they finish their pullback and yields start diverging again from the S&P, and we have a lot of price volatility here. One other thing that contributed was that all the sectors that were acting really bad over in this area and before, like financials, regional banks, transports, they all acted really good over here, and that's pretty much why IWM or small caps are outperforming. So I'll show you real quick. What we have here is a chart of the S&P 500 in candlesticks, and this white line is transports, Dow transports, relative strength compared to the Dow Jones Industrials. This goes back to Dow theory almost a century ago that transports and industrials should confirm each other because the industrials make the goods, the transports ship the goods. So over here you see an area of relative weakness. This is the September market high, S&P record high, and here's the October sell-off and the December sell-off. So what you see is that transports started acting badly relative to the Dow, and right in this area that I was talking about, or coming into this area, you can see transports start really underperforming the Dow Industrials, and when we get into April right here, they are outperforming. This is part of why small caps were outperforming in April. Let me just change this real quick and I'll show you a couple others. So I'm going to change this to the S&P 500. So what we're going to do is compare relative strength of financials to the S&P 500. So here's XLF financials. So again, same thing over here at that September record high. You saw financials not participating. They didn't make a new high. They're showing relative weakness relative to the S&P 500. Over here, they actually showed some good relative strength. In terms of relative strength, they made a higher low. This is one of the very few positive or constructive signals over here, because this is just the plunge protection team coming in and Powell coming in right here with his dovish pivot. Point being, the financials were not acting well, not participating well. Just huge deterioration. And here is the March FOMC. So this is that day that the S&P was up 1.10%, the next day down 0.9%, almost 2%. And you can see this plunge in financials. That's because of the yield curve inversions. Financials don't like that. And ever since April, they've been performing better. Another one is the regional banks. They're kind of even more sensitive than the financial sector. They're part of it, but more sensitive. You see, again, relative weakness over here, confirming the early part of the rally, and just really falling apart in here with that yield curve inversion right there. And the point, again, is since April, they've been acting much better. So I hop back to the SPY chart, the S&P, and one thing I want to mention first, as bonds finished pulling back and started to move a little bit higher, better relative strength, this volatility really picked up. As you can see, I'm talking about price volatility. So we have big swing here, down, big swing, up, big swing, down, big swing. Much, much different than this week or this week, just kind of going sideways. Let's take a look at the Dow. I'm going to use the diamonds, DIA. And here's that same trend. Here's the bottom in late March. Here's April's trend. The Dow came down through this trend line and back tested right up to it today. This is kind of what I expected for the broader market, the S&P and everything. S&P went a little bit above, but the point is we are seeing more of that volatility, and we have some trend breaks of this April trend. And let me pull up QQQ for the NASDAQ 100. Again, here's the April trend line, and notice how volatile this is getting. If we look at SPY real quick, SPY had a constructive little pennant here, and it broke out from that, and this is the Federal Reserve reaction down. If we go back to QQQ, the price action here is not as constructive, not because it broke this trend line, but this is something I pointed out at the same time I showed you the SPY little pennant. Let me just draw in a few trend lines here, and you'll get a sense of what I'm talking about. This is about, what is that, 191, and then if we draw in a trend line over here, what you have is somewhat of a broadening formation or a megaphone formation. Sometimes when you see these in really big price charts, big price action, they're called broadening tops or megaphone tops. They're not constructive. The reason why is you have a solid level of resistance here. It's been tested 1, 2, 3, 4 times, right? But each time it's tested, it makes a lower low. So lower lows, lower lows. Now, if it were something like this, it was bouncing into resistance, over here, but price was making higher lows. This is a very constructive, positive price pattern. It's called an ascending triangle. So basically it's hitting resistance here, coming down, hitting resistance, coming down, but making higher lows the whole time, building up tension towards a breakout at this apex. This is kind of the opposite of that. And one other thing I want to touch on real quick is S&P sectors. I'm going to start with the healthcare sector because in April, very, very dull trade, but the one area that was interesting was the healthcare sector. So this is XLV Healthcare. I'm going to roll this chart back a little bit. So here is our December sell-off. Here is the very V-shaped, very unusual low. Usually what you would see is price come down here, test that, maybe make a slightly higher low, and then recover. This was very V-shaped. It's very unusual, but the reason behind that is, and all the sectors look like this too, it's not just healthcare. The reason behind that is the plunge protection team was called in on December 24th. You can look up Steve Mnuchin, the Treasury Secretary's tweet on December 23rd, Sunday, that he's made calls to the banks to make sure their liquidity is okay, and then at the end of it he slips in, and I am gathering or calling together the plunge protection team, which is called the President's Working Group on Financial Markets. So that is what was behind this V-shaped low. And over here, Apple downgraded themselves more or less, and the market looked like it was going to come down, retest this, which would have been constructive. A lot more people would have been involved, and instead we got Powell's dovish pivot the very next day, and that saved the market right here. So the point is, XLV, like many S&P sectors, confirmed on this early trend in January, February, and then it basically goes sideways for March and April after it broke this trend line here. Little bear flag there, and just bounces around. This is a symmetrical triangle. In SPY's case, when it's 3 or 4 days long, it's bullish because you basically look at it, what is the preceding trend? This triangle itself has no bullish or bearish bias. It is the preceding trend that gives it a bullish or bearish bias. But when they get big like this and they go on for a couple months, this represents massive uncertainty. I'll show you one example of this real quick. This is UNG natural gas. We had a really fantastic trade in this. So let me zoom in a little bit closer. So it has a very constructive base here. Again, that kind of ascending triangle. Resistance is clear, but we're making higher lows over here towards the apex, and a breakout, a bull flag here, another breakout. This thing just was amazing, the move, and especially for natural gas. But the point I'm getting to is this big triangle. And if I take off the trend lines, you'll even be able to see it without them. See the triangle here? Now this lasted over a month. That represents massive uncertainty. If it was a small triangle, it would be a pennant because we have a bullish preceding trend. We would expect it to break out again. The bigger this gets, the more uncertainty builds up, and then prices just collapse. So let's jump back to the healthcare sector. And the point I was getting to was we have a solid uptrend here, January, February, big uncertainty moving sideways, and then this really horrendous sell-off breakdown. This is the second most heavily weighted S&P sector, just behind technology. It's just bouncing here like dead cat bounce or correction sense. Now, another interesting one this week was the energy sector, XLE. Here's the December sell-off. Here's that V-shaped low, and here is the Powell pivot. So we get this trend, right? And a lot of noise has happened here. So, I always update my trend lines as price develops. And if we go into this week, let me just zoom in on a 15-minute chart. You can see breaking down towards this kind of the center line of the trend, a little bit below that, and over here, and then breaks down this week. Now that is because crude did something very similar. Let me just show you the trend here of crude. So there is the December low. Trend has been rip-roaring strong, right? And this week, or coming into this week, we had a first really impulsive, sharp breakdown. Then spent 3 days in this little bear flag. And here's the measured move target down here. Crude oil bounced off its 50-day moving average right there. And it's just hugging the bottom of that trend. Crude has an extraordinarily high correlation with the S&P 500. So if this breaks down, it's going to pull the energy sector down more, and it's going to start to have a more negative effect on risk sentiment and on the S&P 500. So back to XLE, the point was that this sector, you can see that little bear flag again, like crude, and here is that uptrend line breakdown below it. The other one of interest this week was the most heavily weighted sector, which is technology, XLK. The meat and potatoes of the market's advance has been very strong. So its trend that I have here, this channel, this comes all the way back from the December 4th low. So I drew a trend line here, the first correction. This is Apple downgrading themselves, and this is the very next day that Powell comes in. Intra-meeting, by the way, not at the next Federal Reserve meeting, between meetings, and 3 weeks after he was very hawkish, did a complete 180. Everything's on pause. We're going to stop the balance sheet roll-off. Market loved that, and you can see as XLK, tech sector, has been trending towards the top of this trend. In April, it is trending towards the bottom of the trend. Now, it's still going up. It's still strong. It's still, bullish. But there is a change in character here from the top of the trend to the bottom of the trend. And if we zoom in closer on a 15-minute chart, let's go to a 5-minute. This is what happened this week. Now, part of this is Google. Part of this is after the Federal Reserve. But it broke down this trend line. It had done that a little bit last week. It broke down below that trend line this week, and it has kind of bounced the last day and a half or so, and I suspect maybe it tests up to the bottom of this trend. So you've got the most heavily weighted sector having broken the trend. You've got the second most heavily weighted sector, healthcare, having broken its trend in that big symmetrical triangle. And you have the energy sector and crude also either breaking the trend or tangling with it. One more I'll mention real quick is the industrial sector. Here's that April trend. Here's the FOMC meeting. Now, before it broke this trend line, which was the uptrend from the December low, and we got some kind of flags in here, breaks down. This is that end of March into April. So it recovered too. And it has been kind of back testing under this trend for almost 2 weeks now. It's not a clear break, but it is clearly something to be paying attention to. Now let's get to the really interesting stuff. And for that, I'm going to jump back to the SPY. So what I'm going to do is pull up the VIX. Now let's move back into this April trend. Here's the FOMC March meeting. the big yield curve inversions, and the S&P down almost 2% on that day. Volatility soars, right? Trend starts moving up, volatility comes down. This is that area I was talking about. We're seeing all that underlying buying or selling pressure, more buying pressure than selling pressure. Look what happens here. This is relative strength in volatility, and it starts just about that week. So what you have is the opposite of what you should normally see, which is that VIX is trending up with the S&P. Highly unusual situation. Let me show you one other thing. I'm going to pull up VVIX, the volatility of VIX. This is an index. It's not a traded product. Here's the spike as the market went down, the flash crash in yields or yield curves inverting. Same thing here. Look at this trend of relative strength. This indicates that there's hedging activity taking place. Basically, somebody is hedging against downside risk, but in quite an unusual manner and pretty extended. And I mentioned this is an index that does not trade because I suppose you could manipulate it, but there's really no point in manipulating it because unlike VIX or volatility in general, it doesn't have that positive effect for the market. So this is kind of a truer sense without any kind of manipulation of what is going on here in terms of hedging as the S&P is moving up. Now, to really put a fine point on this, I am going to show you something that we don't see very often. Okay, so this is the S&P 500 from about December of 2017 in 2018 and 2019 currently. And on the bottom here, what this is correlation between the VIX and the S&P. So being that they move opposite of each other in a normal environment, you would normally expect to see the correlation down here about -1. This is 0, okay? And these spikes are VIX correlating, having a very high degree of correlation with the S&P. So that whole area I pointed out in the last chart, that's right here. And as you can see, when these kind of things happen, it is indicative to me, anyway. I mean, I can't explain it 100%, tell you who's behind it and why, I don't know, but is indicative to me of increased hedging activity in volatility, expecting some kind of a negative event coming up. So we can see the two big sell-offs in 2018, the February one and the October one, were preceded by these signals. We have one here. This is part of a bigger signal, actually. And we have one here that spikes just a few days before the market really sold off. And over here in September, later in that month, we started to see the market come apart. And in October 3rd, it started selling off. So we have that same signal over here. In my opinion, I think somebody out there knows something that the broader market doesn't know. I speculated earlier today that maybe trade talks with China aren't going as well as the market thinks, and somebody's aware of that and is quietly accumulating volatility, or basically a hedge against downside risk. So that's what we saw over here. That's what we saw over here. This is a 10-day correlation. So when I talk about these kind of separate signals, these are actually one big signal in a 30-day correlation. Now, is it an infallible indicator? No, of course, nothing is an infallible indicator, but you tend to see when they peak up, we get some volatility in the market. Sometimes big corrections, sometimes small corrections, but generally corrections. So you can see right here another one. Now, I'm going to show you real quickly, as we're looking at this area, the 30-day correlation, which is an even bigger, more spectacular signal. And here we are with the S&P 500, and I have changed this to a 30-day correlation. So when we see kind of the normal reaction or activity in volatility, it should be down here at like -1 correlation. And this is a very unusual spike in correlation that really started back in here that on that 10-day correlation where I showed you there were two signals right before this sharp February sell-off. This is a very rare and meaningful signal above 0.4. Okay, it won't get up to +1 because there's so much. There's 30 days of data. It's like averaging. The longer you make the moving average, the more diluted the data becomes. So if I'd made this 20 bars or something, it would probably spike up to about 70. But the point is that this 40 level right about here is the threshold historically that leads to some major market corrections, or you could even say tops, big financial events. And when they occur, in this case we got a sharp sell-off really fast, but when they occur, they usually mean something bigger is going on. So during this ramp up, the VIX correlation with the S&P moving up was very clear, very strong, and the financial media, the CNBC types, were saying, oh, that's not a problem, it's just because of call buying, it's bullish. All you have to do is look back historically for yourself, and that's what we're going to do. Remember, this 0.40 level is the trigger. There have only been 4 of these since 1998, so in the last 20 years. Here is one, and this is 1998. This is the Russian financial crisis, long-term capital management blowing up. If you know anything about long-term capital management, it was like the fund of all-star managers blows up over here. So you can see this preceded that blow up by, let's say that was April, and we come into here, that's about July. That was a major event. And then if we move forward, remember 0.4 over here is our signal area. This is the top of the .com bubble. That led to a big bear market. And if we move forward, the next signal we get is right here, which is May of 2007. The S&P made one more record high here and one more record high here, and then started to sell off in October. This is the financial crisis. So the first signal was the Russian financial crisis and long-term capital management blowing up. The second was the .com bubble and the bear market there. The third one was the great financial crisis, and we did not get another one above 0.4 until there's 0.4, January 2018. My opinion is that these show up in history at times where we have major market events. So we had a big sell-off in February, another big sell-off October, December. As far as I'm concerned, this signal is probably still valid, and we're still probably making some kind of a big top in here. In terms of the more tactical trading, 10-day signal, as you've seen, marked events here, and now we have another one here. This is going back to that relative strength that was building up as the S&P was doing nothing a couple of weeks ago, and then we started to see that buying pressure really moving price of volatility. While we're on the subject of volatility, I just want to show you one more thing. This is the chart I posted earlier today. It's VIX, okay, and it's going back to February, and I showed all these Fridays in red arrows and one green arrow. 13 out of 14 Fridays, volatility has been down every single week. I went back and I looked from January, every single Friday from January, volatility was crushed. So that is 17 of 18 weeks that volatility has closed lower on Fridays. It's very clear that there is a concerted effort to ramp the market Friday, make it look good and close strong into the weekend, make people feel confident. You don't see this kind of consistency. True, it's in a downtrend, so you're going to have more down days than up, but when you get to 17 out of 18 or so days on Friday that it's down, that's just beyond coincidence. The only day that it was up was right here. This was the yield curve inversion after the FOMC meeting here, and the S&P was down almost 2%. So that is the one exception. They couldn't control that. Yield curves were inverting. You had a big growth scare, and people were panicking. Speaking of growth, one other chart I found today, and I wanted to just show everybody. This is global PMI. PMI is the Purchasing Managers Index. It's basically a read on the health of the economy, how things are going for manufacturing and services. Here it says longest losing streak for global PMI over here. And the source is Charles Schwab and FactSet. So I trust the data. They're reputable sources. Over here, you can see PMI deteriorating. This was the tech bubble popping, okay? Over here, you see it deteriorating, getting bad. This is the financial crisis. Over here, this is from January 2019, or actually a little bit before, but the global data deteriorating. So the whole time the market has been rallying, the S&P and NASDAQ have made new highs. Meanwhile, the economic data in terms of PMIs has just absolutely gone the other way. So that is it. Thank you for listening. I know it was long. I'm very sorry. Have a fantastic weekend, and I will see you either Sunday night or Monday morning.